Hey everyone, thank you for tuning in to Real Inspection Services. This is your host, Chuck Ryan, here to discuss all things regarding your home and the home inspection industry. Hey, this is Chuck Ryan. Welcome back to Real Inspection Services podcast. Today I have a special guest with us. He is a lender extraordinaire, Guy Grimaldi. Guy, tell us a little bit about yourself, how many years you've been in the lending business, and just share with our audience the name of your company and what you specialize in.
Thanks, Chuck. First and foremost, thanks for having me here today. Very glad to be here. Guy Grimaldi, First Community Mortgage is the name of our firm. We are a bank-based lender based out of Nashville, a small boutique bank, small but mighty, and operating here remotely in the Chicagoland area, lending in all 50 states. Hard to believe, but I've been in the industry 22 years now and worked for banks, brokerages, and credit union even, and found this to be the best of both worlds. So very happy to be part of First Community Mortgage.
And just so the audience knows, we met that on an inspection that I did for you and your wife in Chicago.
Absolutely. Yes, you were nice enough to help us out with our inspection, and we did not have an easy closing process, I'm afraid to say, but we got through it, and you were just very, very integral in that resolution, and so we can't thank you enough for looking out for us. I mean, one of the things that really struck me and my wife was just that you really care about your clients, and you really do a very thorough job and look out for them, and so that meant a lot to us, so thank you.
Yeah, I appreciate that. I remember the first day, I think we made a couple of trips out there, but I remember the first day we were out there, the general contractor was out there and we were identifying some conditions with the home. And I remember that up in the attic, there was a lack of access to get to the furnace that was all the way back there. We had some insulation issues. So these are obviously some of the things. And Guy and his wife, they were buying an older home that was completely gutted and remodeled. So on my earlier podcasts, I believe we did discuss the importance of getting a home inspection, even on a rehab, as well as a new construction. So, but I thank you for that. That's nice things to say. Okay, so give us some ideas what a new buyer can look for when they're looking at a lender, some of the information that they can provide to you as well as the feedback that you can give them.
Great question. I work predominantly with first-time buyers, as a matter of fact, and it's not an easy market for first-timers. This is an environment where we're seeing elevated prices, of course, elevated interest rates, affordability is at an all-time low, and it's, frankly, it's a challenge for newcomers, even returning buyers. First time around, it's very important for a buyer to understand what their qualification looks like. And by that, I mean credit report, certainly, having a credit report pulled, identifying items that may be incorrect, that may be affecting their credit score adversely, that if we have enough time and we know far enough in advance, they can improve. Statistically, about 20% to 25% of consumers have something on their credit report that is inaccurate. So it's very important to identify those things as early as possible so that we're optimizing the interest rate someone gets, we're making sure they qualify. So it's a you don't know what you don't know scenario. We've got to unearth everything that's going into their qualification, credit, of course, being very important. Income is also extremely important in qualifying. Folks with variable compensation, whether it be bonus, whether it be overtime, these are things that we need to calculate how much income we have to work with as early as possible so that we can really understand their budget and help guide them not only to the right property that they love, but also the right property that they're comfortably able to afford and that they don't feel overextended. So I think big picture, it's really about doing as much research and being as prepared as you possibly can as early as you can, because once the property has been identified, this is a market that moves very quickly. So it's do your research early and be able to move quickly when the time comes so that you feel prepared and it's not any more stressful than it has to be when that dream home pops up.
So you mentioned something about when you pull a credit report and the information is not as accurate. I remember when I bought my first property, there was an inaccurate credit report on me having a Sears credit card from 1974 I was born in 1966. So the weird part about that is my dad and myself share the same first, middle, and last name. So it was actually his credit report that they were looking at, but somehow it made it to mine. And I just looked at the guy and I said, that's a new one on me because I never had a credit card back in 74. I think I was what? If I was born in 66, I was 8 years old. So, I mean, come on.
You got an early start.
I got an early start.
That's right.
Okay, so the people have made it that far. They provided you with all the information. What would be the next step? And one of the things that I do find is when people hire us for a home inspection, they will say to us that we're maxing out on this property. And I always almost feel like saying to them, why? Why are you maxing your limit out of what you're able to afford? And they will say to us that we can't go any higher than this. We're at our max limit. Therefore, if there's any inspection items that come up, we won't have any room to negotiate because it's being sold as is. And I almost feel like saying to them, we are going to find problems with this home. So I just don't understand, why people will put that challenge ahead of them. And like you said, you make this as less stressful as possible when they go through this process. And why do you think people do that sometimes?
Well, I think it goes back to interest rates being where they are and home prices being where they are. If you look at the payments that we were calculating in 2020 and 2021 when interest rates were in the 2s and 3s, just hundreds of dollars, in some cases thousands of dollars less. And so people are really stretching their budgets to get what they feel comfortable in and what they feel is worth the move. And by the time that's all said and done, there's oftentimes not much left over. So there is usually a period of discomfort financially for most first-time buyers in the first year or two when they move in and settle into a property. They're adjusting to what is oftentimes a higher payment. They're adjusting to some of those unforeseen expenses, or maybe even if they are anticipated maintenance and upkeep costs. It is something that they're not used to as a renter, and so they have to factor that into their budget. So there is an adaptation that they go through in terms of establishing a new budget. But at the same time, hopefully, they're getting raises, bonuses, advancing in their career. And so that's helping them offset some of those financial challenges. But I believe in being prepared. There's no such thing as over-prepared. So I caution buyers, don't put too much down to where you don't have a savings account still. Don't overextend yourself any more than you absolutely have to. And it's better, truthfully, in my opinion, to have several $1,000s or maybe even tens of thousands, depending on what the price point is, in cash in the bank rather than a marginally lower mortgage payment. I would rather see a client have $10,000 in an emergency fund than a $50 a month lower mortgage payment.
And that's something, even though it's a little bit of outside of our scope of what we do try to educate them to let them know that these are real costs that can come up being a homeowner. Like you had mentioned, the unexpected costs. A lot of times I don't think people take that into consideration. If it's a home that's been updated with a new roof, new appliances, but then the furnace and the AC are older, sometimes they don't take that into consideration, or they kind of cross their fingers hoping that it can get them maybe the next 2 or 3 years. And those are some of the questions that we get as we do the home inspection. Hey, can this last me another 4 or 5 years? Well, I wish I had a crystal ball to tell them, yeah, but we don't, right? So we're commenting on the condition the day of the inspection, and we can't foresee those things. And that's sometimes a challenge for us too, as well as a home inspector. But especially today with the cost of living, everything's pretty much has gone up about 22%. From groceries to gas. I mean, I filled up my car yesterday and it cost me almost $85, to fill that up. And I've seen the gas prices have gone up. So to your point, I think those are some of the things that they do need to take into consideration when they are buying a home, that, hey, we are in a period right now where everything has gone up. The GDP was down, I think, 2.5% or something like that as of recently, or 1.6. So, Again, these are all things that do factor into that. And I think sometimes it gets lost. Even when you've coached them, they see that house and they want it. Doesn't matter, right? So, but that's where our challenge comes into play. One of the other things that we have seen, and we've actually had a couple inspections that have were canceled, and they were canceled because they've gotten that far with the loan process, but then something came up, and we get the call where it's our financing fell through, and we had two that happened this week. So explain to the audience why that can occur sometimes.
Well, this goes back to the pre-approval process. And actually, at First Community Mortgage, we typically advise our clients that they take things a step further and upgrade their pre-approval to an actual underwriting approval. We have the ability to do that. It's something I do recommend clients take advantage of. There's no cost or obligation to do that, but it's something that's going to help them submit a stronger offer when the time comes and a more well-qualified offer. This is something where by collecting pay stubs, W-2s, a driver's license, a couple bank statements, it's pretty straightforward, pretty easy documentation. But by doing that additional step in the due diligence, they're better prepared and they actually have a binding conditional loan approval to go into that offer. And that can help avoid some of those issues that you're talking about, where what I see is going back to the income calculation piece. People have variable income, they have bonuses over time. Restricted stock is a tricky one to underwrite. So by doing that in advance and knowing exactly what the maximum payment someone can qualify for is, that's really going to avoid a situation where you find the property, you get it under contract, and Lord knows it's difficult to get one under contract these days. You get that far and it's your dream home. Your hopes are up, things are looking good. You submit the file to underwriting then and find out some unpleasant news. Whereas planning for that and making sure your ducks are in a row before the property's under contract and before your file goes to underwriting, that's just going to help make for that much smoother of a process.
So with that in mind, you think that it's basically they're not being educated through other lenders they can be working with, that they're not telling them, hey, this is a possibility that can happen if it goes to this stage. You may have a point where this can not go through. Right? So they've called the home inspection company, they've hired the home inspector, but there is that possibility that the funding may not go through.
Yeah, I see with some other lenders at times, it is a bit of a numbers game for them. They want to have as many clients as possible. They want to close as much business as possible. We're all in this to make a living. I can certainly relate to that. But the level of due diligence that they're taking the time to do with each individual client, the level of education, I think that's one area where we really shine and we really do provide additional value for our clients. I'll oftentimes spend an hour, hour and a half on the phone with an initial consultation to make sure that they understand the process, all of their questions are answered, and we really are being very thorough. I don't want my clients to enter into anything that they don't understand, that they're not comfortable with, where the budget doesn't feel right, and most of all, that they're going to be able to close when the time comes. That's most important, and close comfortably and close confidently. So I think it really comes down to the consultation initially, taking the time to make sure that we're doing all the due diligence and that they're prepared.
So you're setting their expectations, basically. You're giving them and you're laying them out basically a plan of how to get from point A to point B to point C to close, basically. So there's no expectations that weren't met, that you've explained everything to them.
Exactly. Setting expectations and exceeding expectations, that's one of the most important things, expectation management. It's one of the most important things that I do in my role in the real estate transaction. And I think it's just something that's critically important. Even myself as a consumer, I really set a big store by expectations. And I think that not painting a rose-colored picture is critical in that I want to set realistic expectations. I want my clients to know the best case, the worst case, and what's in between. And that way, nobody feels let down, nobody feels misled, and we're ideally exceeding expectations in all cases, and people are walking away from the closing table very happy.
So that's a bunch of great information, and I hope the listeners were taking note on that, because that's very important, is to come into this with your expectations and to know what you can qualify for. And here's the bottom line, to listen, right? You're giving them your expertise over years of being in this industry. So those are the important things. And sometimes those are the challenges we come across in our industry too, is we could say something and we find it may have gone in one ear and has jumped right out the other ear. And we sometimes have to bring them back to reality. And it's a challenge. It's a challenge. One of the other things that you had mentioned to me is you do new construction loans, correct?
We do. We do renovation and new construction.
Maybe explain to the audience what that entails.
Absolutely. So this can be a very good option, either one, renovation or new construction, if a buyer is having a real hard time finding what they want in this market. And that's a reality for a lot of people because inventory is so depressed right now. We're hoping that changes as interest rates come down and time goes on. We hope more sellers sell. But at this point, we have insufficient supply. An alternative for many folks who are submitting offers and maybe not getting them accepted, start looking at the properties that have been sitting on the market for a long period of time. Maybe they need extensive work, and that's where a renovation loan can come in. You can borrow hundreds of thousands of dollars if that's the scale of the project, and the property will have its value justified once the work is complete. So this is a tremendous opportunity. Even if there's structural issues, you can really tackle any project. And that's where our network between the two of us in terms of contractor referrals and things like that, we can really help people put those pieces in place because let's face it, a big renovation project is a daunting task. You need somebody with the vision, you need somebody with the know-how to help the buyer execute, but also new construction. If they just want to start with a blank slate, build from the ground up, that's something we can help them with too. You can put as little as 10% down on a new construction loan. And that can be something where you already own the land. Maybe you're buying the land at the same time. The general contractor you can work with, it's completely up to the buyer. There's no restricted list. It's a very flexible program. You make payments for the first year. Usually the construction timeline is a year. You make payments just based on what you've drawn to build the property up to that point. Maybe you pour the foundation, do the framing initially. You're making interest-only payments based on what you've drawn to do that. So it helps keep the payments manageable while you're under construction. It is a one-time close. That's also key. If interest rates continue to go up, you've already closed on the construction loan. Flash forward a year, maybe interest rates are another point higher. You locked in when you closed with the single close initially. You don't have to reclose. A lot of construction loans are a two-time close process where you do the construction, you get the loan to build the property, and then at the end you have to refinance that and you're subject to wherever the market is at the time. With our single close product, it's a one and done. You can always refinance it at the end if interest rates are better and it makes sense to do that, but you don't have to. So it's really a great alternative for people who are just not finding what they want. And even if they're finding some properties that check some of the boxes, with new construction, you're really making the decision on all the finishes, the size of the property, the features and the amenities of the property. So it really gives people ultimate flexibility to do whatever they're looking for in a property. So it's whether it's renovation or a ground up construction build, we can help with that in this market. It can be a great option.
We have inspected a lot of homes where, just like you had said, they're homes that need a renovation. It could be an older home that hasn't been updated in 20 or 30 years. What we've come across too is when the buyer is there and we're doing the home inspection, they'll just ask us, hey, what do you think we should budget for this? Or what do you think we need to budget for that? And we don't give estimates. We do give budgets. And sometimes we'll spend time after the inspection to go through it with them. And then it gets to a point to where we will tell them what we project the budget to be for that. So at least they're aware of where they're at. And it seems like the clients that we've worked with, they know where their budget is and they can't exceed it. So they move on to the next property. So it kind of what you were saying in the beginning, they know what their expectations are. Their expectations has been set and they know what dollar amount they can go and they can't go over it. And we always tell them money doesn't lie, right? You can't change it. It's there. That's the main thing. If you can afford $120,000 construction rehab, that's what you can afford. Can't go over that. Right. So then you've exceeded that and they could put themselves behind an eight ball on that. So, and just like you had stated earlier about having some reserve cash in the bank, we always will let them know. Some contractors will say to hold maybe a 10% to maybe a 15%. what they call a fudge factor for other unexpected costs that can come up. I like to go a little bit higher to be more conservative that way because I have found that it typically exceeds that. So maybe you can talk about that, your experience with that. If people are set for a certain dollar amount, do they try to maybe wiggle a little bit more money if they can afford that?
Yeah, that's something that we see quite often, whether it's deliberate or unintentional. Whenever there's a renovation or a construction project, ground up build, whatever someone's doing, it's very, very easy to go over budget. And it can be unintentional where things come up with a renovation and there's maybe a structural issue that comes to light or something that's not initially known that all of a sudden increases the budget significantly and unexpectedly. It can also be deliberate in the sense that if someone's building a new home, I went through this myself. You want to get that nicer kitchen faucet. You want to get the little bit nicer flooring. And well, maybe if we just do this here and that there, and by the time it's all said and done, you've really, it's death by a thousand cuts. It's really added up and you're over budget. So I think that we do as a company require a 10% buffer in there. The estimate is padded 10% in case things exceed the planned expense. I agree. I don't think it's a bad idea to have extra money set aside beyond that, if possible, just in case somebody does want to splurge on, the deluxe countertops and upgraded cabinets and things like that. I mean, we all appreciate those things in our homes, and it's nice to have things that make our homes more enjoyable. But you do need a good contractor. You do need a good team around you to help determine where you can not necessarily cut corners, but make efficiencies, make economies, and then where you can really put your resources where it counts.
And that's the important thing, what you had mentioned just a few minutes ago, is having a good team. And I believe in that. And that's important because then that helps things move along a lot more smoothly, and it can help with those unexpected bumps or hurdles that come up, and you do have that support there for you. Okay, so we're doing this podcast. Today's April 26th. It's a Friday. The interest rates currently are at where right now?
In the mid sevens. It very much varies depending on the individual buyer scenario, but I'd say by and large mid sevens.
I know that they were talking back when the interest rates went up. They were forecasting possibly maybe 2 or 3 rate drops. Really haven't had any yet. Where do you see the interest rates going forward? Do you see them maybe dropping a little bit prior to our big election coming up here in November? Do you see them staying steady at maybe 7%?
Yeah, that's a great question. Certainly one that's top of mind for everybody that's in or around real estate or considering getting into the market. In terms of where interest rates are currently, they are higher probably than where we would have expected them to be at this point in the year. Going back to October and November of last year, they were projecting as many as 6 interest rate cuts from the Fed this year. Inflation is really the driver. What we're looking at is persistently high inflation. We've had some inflation readings, particularly early this month in April, that were higher than anticipated. And so as inflation continues to be, as they say, stickier than expected, we're seeing interest rate cuts pushed out further and further. And now the market is widely anticipating we'd be lucky to see 2, possibly only 1, maybe none at this point. We'll see. Today's inflation PCE reading came out. That was right in line with expectations, but for the last 90 days, we've been getting higher than expected inflation readings. And the Fed is really following this, quote, dot plot, as Fed Chair Jerome Powell refers to it. They're very data dependent, so it's really just all going to depend on where inflation goes in the coming months. And for that matter, the coming years. As inflation decreases and loses momentum, consumers will see reduced interest rates. But until that time, Jerome Powell and the Fed team is really committed to not lowering interest rates any sooner than they have to, and that's necessary to combat inflation as they see it.
Yeah, it's the challenge that we have too in our profession. It's kind of hard to convince a homeowner if they're at 2.5% to 3%, if that's what their current rate is. How do you convince them to move?
Yeah, that's a big factor. I think a lot of people are held hostage, so to speak, by interest rates in the 2s and 3s. And really, as an industry, what we are seeing or projecting is when interest rates come down into the mid 5s, that's kind of the quote unquote magic number to free up existing homeowners, move-up buyers where they feel comfortable listing their property and purchasing a new property. Now, why is 5.5 significant? Well, psychologically, a 2-point range will say where if someone has 3.5 and they go to 5.5, they're psychologically comfortable with that kind of step up in interest rate and are willing to sacrifice a 3.5 for a 5.5. Also, too, 5.5%, of course, is about 2% lower than where we are right now. So you're talking about a significant reduction in the principal and interest payment being paid for incoming buyers. And so really what people are looking for is, depending on which end of the spectrum they're on, whether they're an existing potential seller or an incoming buyer, we're really looking for something in the mid-5s ideally to really drive a lot of activity in the market. But it's very specific to the individual. Some people are forced to make a move or really want to make a move because they've gotten a promotion or something related to their job. Maybe they're having children. I have a client who's actually also a real estate broker recently. The family suddenly grew and they just absolutely had to have more space. So a lot of people are being driven by changes in their lives, but a lot of people are just making financial decisions. And so in order for that to get easier, we need to see lower interest rates, and the lower the better, and 5.5 would be a great thing to see that activity pick up.
Yeah, it's a challenge for sure. I know that our business would completely boom if that happened, and we're staying consistent, we're staying busy, but like you had mentioned, with that 2% rate drop, I'm sure that the market would be flooded and we would be busy. But it's just one of those things we just kind of have to grind our teeth and just deal with it, right? Just to keep moving forward and just to kind of stay consistent with what we're doing, providing good home inspections, and as well as what you're doing, just educating first-time buyers as well as people that maybe want to get a construction loan.
Yeah, I think the interest rate drop, it'll certainly be a welcome thing for many people, myself included, but it's a double-edged sword. As interest rates come down, especially if they come down in a really meaningful, significant way, it's going to drive a lot more activity to the market. And we've been talking about that, and in some ways that'll be good for inventory. But what it'll also mean is it'll increase people's buying power and therefore will drive prices up further, because unfortunately there's no real easy solution to this inventory issue. And so as people's buying power is increased, they'll be willing and able to pay more for the same inventory that's on the market now. So I feel that right now is a good opportunity for buyers to get into a property. They can always refinance when interest rates come down, and most of the loans that I do for clients refinancing, they have very low, maybe $500 in cost, or maybe not even any cost. We get them a lender credit to cover the cost of the refinance. So really the imperative thing right now is to find a great property you love, not really base it on the interest rate if the budget allows for that, and refinance when things normalize with interest rates. But what we are definitely going to see when interest rates drop is people coming to market, increased competition because of that activity, and increased buying power that's also going to enable them to pay even higher prices than they are right now. So statistically, when interest rates drop 1%, 5 million buyers nationally enter the market. So if you're talking about a 2% drop, that's 10 million buyers that are not currently in the market coming to the market because of that reduction in interest rates. So it's a significant move of the needle, and it could make things more challenging for people who have not yet found a property.
One of the things that I keep hearing from realtors is that with the sellers now, they're kind of in control. And because of the lack of inventory that's out there, they can kind of price their home where they want to price it at. And we've had people that have come to us, again, our clients that will say we're paying $20,000 or $30,000 over asking because they want the house. It's because of the lack of inventory, right? It's the whole supply and demand thing. Now, so what I understand is that if the rates drop 2%, let's say they get to 5%, you're going to have the rush of activity coming back in the market, and the sellers are there saying, give me your best offer.
Yeah, exactly. I've seen properties. There was a very nice 3-bedroom. It looked like it could have been an Architectural Digest. It was a beautiful unit, 3-bedroom in East Lincoln Park. It had close to 30 offers, according to the listing agent. That's extreme. That's not what we're seeing on every listing, thankfully. But yeah, that's an indication of how competitive the market can be in the case of certain properties. So, of course, if you add more buyers with more available financial capacity, that it exacerbates that issue. And I want to say, I don't think that property's closed yet, but we were approximately 75,000 to 100,000 over list on that property. And that's already very difficult for a lot of people to accept as a buyer. And if that gets even worse, to your point, the comparable sales in the market, the properties that have closed recently that are normally used as a guide, it almost takes the comparable sales out of the picture because they no longer really have any relevance to where the market is evolving. It's moving so quickly and it's going up so aggressively that a lot of buyers just have to figure out what number that they're comfortable with. And in some cases, it's extreme and it's hard. But if somebody's going to be in a property a long time, we do anticipate about 6.5% appreciation year over year. We're coming off 6.5% appreciation year over year in March. It is in some cases justified, again, just due to supply and demand. But no one knows what the future holds as long as the job market is stable and continues to be strong. I think that's very important as well. So, we'll see. But it is challenging for buyers right now, which again is why just making sure that you're that much better prepared than the next person with an approval, with doing all your due diligence as early as possible, being able to move quickly. It's very important.
So the way I understand what you have said and basically what we've discussed is if you're in the market to buy a home right now, this isn't that bad of a time to get into the market to buy a home, even if the interest rates are a little bit higher, lack of inventory. But if you do find that home, you're avoiding that rush when the interest rates drop and you're avoiding the multiple competitions. And I feel that you're going to be dealing with multiple offers and you may lose out on those offers, right? Because the sellers are in control right now. And once those rates drop, like we were talking about, there will be a flood of more interest and more people into the market. And that's where you can have the competitive rates and, you can lose out on that property. Challenge is lack of inventory right now. But if you find that right property, they say, date the rate, marry your home, right? Mm-hmm. And I know that's something that's been going around. But so would you say that even though the rates are a little bit higher right now, this still is not a bad time to get into the market to look for a home?
Yeah, I think it can be a good time. I think it's very individualized. I'm not a real estate professional who will say that it's always a good time to buy for everyone. There are certain advantages to renting depending on what somebody's got going on in their life. If they're moving a lot for work, if they have certain things going on that doesn't make it equitable to put down roots and stay somewhere for a period of time. But by and large, if somebody's considering buying, it's very easy to look back and say, woulda, shoulda, coulda. Don't beat yourself up about that. This is a good opportunity. And if you find the right property, it's all about finding the right property. If you find the right property, don't put your life on hold because of where interest rates are. Don't put your life on hold because of a fear over what may or may not happen in the market. If the numbers make sense and you really like the home and it improves the quality of your life, move forward. And I would say in terms of any type of buyer's remorse, I think the remorse that I'm seeing is really just a product of not feeling prepared and not feeling that things moved too quickly. And they do move very quickly in this market, but feeling like they were playing catch up, feeling like they rushed a decision. If we spend enough time on the front end making sure that the budget is determined, the numbers are comfortable, that eliminates a lot of that risk. But yeah, I think now is a good time. I think that it's really a pick your poison proposition. Do you want to pay, let's say, $100 more in interest for a year or two? So $100 a month times 12 months is $1,200, or in the case of 2 years, $2,400. Or if rates come down and more buyers enter the market, do you want to pay $20,000 more for the same property? So it's a good time. It's a good time to avoid that. And we really want to help people understand all of their options and feel confident in their decision one way or another, even if they decide not to buy.
So, Guy, if you could give the audience 5 main tips that they need to prepare for, whether they're looking for a home, first-time buyer, and a new construction loan. If you can provide the 5 tips, and if it's more than that, that's okay.
Yeah, I think there's some key points that are going to make for a smoother transaction and a more well-informed buyer and a more comfortable buyer. And it really is all based on preparation and knowing what you're getting yourself into and knowing the details surrounding that. So knowing what's in your credit report is imperative. Knowing what your income is. That sounds like a no-brainer, but in a lot of cases, someone is not familiar with exactly what they got paid last year in bonus compared to this year in bonus. Being familiar with your savings and your ability to save, having a budget, knowing what you're spending each month is important so that you know not only how much you have to spend, but knowing what you have to spend in the event of an emergency or an unforeseen expense with your property. If you're a renter, these are things that you're not used to having as a potential pitfall. Knowing what your resources are, knowing that you can take a 401k loan. You can borrow from yourself for your down payment. You pay yourself back the interest. It's effectively an interest-free loan. Most people don't know that. Knowing that a lot of the myths are not going to prevent you from purchasing a property. You don't need 20% down. You don't need perfect credit. This is something that, at the end of the day, most of my clients end up saying at the closing table, I didn't think this would be possible, but I certainly didn't think it would be possible this quick. So it's not as out of reach for most people as they think it is. This is something that we really need to work on dispelling the myths with first-time buyers. And when they see how easy it is to purchase a property and how little they need down in some cases. I had a client recently who purchased a $300,000 condo in the city of Chicago. She had $9,000 into the transaction. So it is possible to make your housing dream come true with very little down and sourcing a down payment in a way that you may not have expected, gifts from family. So dispelling a lot of these myths is also a very important part of it. So those are the 5 things that I would say any buyer should be aware of going into this, especially for the first time.
Well, that was great. I mean, you provided a lot of information. I picked up a few things that I wasn't aware of, and be proactive, get out there, start looking at those properties. Obviously, we had a podcast earlier about finding a good realtor, but this just proves my point is finding a good lender. So if you can share with the audience your name again, the name of your company, and how they can get in touch with you.
Yeah, thanks, Chuck. Guy Grimaldi, First Community Mortgage. Last name is G-R-I, M as in Mary, A-L-D as in David, I. I can be reached at guy.grimaldi@FCM, Frank Charlie Mary, FCMHomeLoans, plural.com. Guy.grimaldi@FCMHomeLoans.com.
Guy, that was tremendous. I mean, again, there was a lot of information that you shared here today. I encourage the audience to listen to this podcast more than once because of the information that was provided today. I've known Guy for several years, and I could say he's a stand-up man. So if you need any information, please contact him, and he'll help you navigate the treacherous waters of buying your first home and or a construction loan.
We'll make it less painful for you, I promise.
So remember, when you're out there looking for a home, it's better to be proactive than reactive. We'll talk to you soon. Thank you again for tuning in to Real Inspection Services Podcast. If you have any questions regarding your home or our services, please reach out to us at realinspectionservices.com. If you would like us to answer any of your questions on the podcast, send us a DM on Instagram at Real Inspection Services. All info is down below in the show notes.